The risks of trading options. Hi, it's Kyle, and in this video, we're talking about the risks of trading options. Options are one of the most risky investments you can make, but they also have the potential for being very lucrative if you know what you're doing. If you're considering an options trading strategy, it's important that you understand all of the risks before making your decision. Options trading is a popular investment strategy that can be used to make profits in the stock market. However, it is also a risky proposition, and there are certain risks associated with options trading that every investor should be aware of before they begin. In this video, we'll explore some of the risks of options trading, including the potential for loss, the impact of volatility, and the possible problems with liquidity. We'll also offer some tips on how to mitigate these risks and make options trading a safer investment strategy. What are options? Options are a type of derivative, which means they derive their value from an underlying asset. The most common underlying assets are stocks, indexes, and commodities. When you buy or sell an option, you're betting on the future price of the underlying asset. There are two types of options: call options and put options. Call options give the holder the right to buy the underlying asset at a certain price by a certain date. Put options give the holder the right to sell the underlying asset at a certain price by a certain date. Both call and put options have an expiration date, after which the option is worthless. The expiration date is also known as the strike date. Options can be exercised any time before their expiration date. The price of an option is called the premium. The premium is paid to the seller of the option when the option is bought. The premium is set by supply and demand in the market for that particular option. Options are risky because they are derivative contracts. This means that their value is derived from something else, in this case, an underlying asset. If the underlying asset's price moves in a direction that is unfavorable to the option holder, then the value of the option will decrease as well. What are the risks of trading options? When trading options, it is important to be aware of the potential risks. These can include volatility. Options prices can be very volatile, and this can lead to large losses if you're not careful. Leverage. Options provide leverage, which means that a small move in the underlying asset can result in a large loss or a large gain. This can work against you as well as for you. Time decay. The longer an option is held, the greater the chance that it will expire worthless. This is known as time decay. Inadequate understanding. Many people trade options without fully understanding how they work. This can lead to big losses if things go against you. How to manage risks when trading options. When it comes to trading options, there are a few risks that you should be aware of. Here are a few tips on how to manage risk when trading options. Number 1, know the risks involved. Before you start trading options, make sure you understand the risks involved. There's always the potential for loss when trading any type of security, so it's important to be aware of the risks before you start. Number 2, use stop-loss orders. A stop-loss order is an order to sell a security at a certain price point if it begins to fall in value. This can help limit your losses if the market turns against you. Number 3, diversify your portfolio. Don't put all your eggs in one basket by only investing in one type of security. Diversifying your portfolio will help reduce overall risk. Number 4, review your positions regularly. Keep an eye out on your positions and how they're performing. If you see that a position is losing value, don't be afraid to exit the trade and take your losses. Number 5, have a plan and stick to it. When it comes to trading, having a plan is key. Make sure you know what your goals are and stick to your plan throughout the entire process. This will help you stay disciplined and focused, which can lead to better results overall. Exposure or positional risks. When trading options, there are two types of risks to consider: exposure risk and positional risk. Exposure risk is the risk of losses incurred from changes in the underlying asset price. This type of risk is inherent in all types of trading, but it is especially important to be aware of when trading options since the prices of these securities can change very rapidly. Positional risk is the risk of losses incurred from changes in the value of your position. This type of risk is specific to options trading and can be caused by a number of factors, including time decay, implied volatility, and changes in interest rates. Early exercise and assignment risk. When trading options, there's always the risk that the option will be assigned early. This means that if the underlying security price moves in favor of the option holder, the broker may choose to assign the option early in order to avoid paying out a large sum of money. There is also the risk of exercise. Now, this happens when the option holder decides to exercise their option and buy or sell the underlying security. This can be a problem if the security price has moved against the option holder, as they may end up losing money on the deal. Both of these risks can be mitigated by using stop-loss orders or other risk management strategies. However, it is important to be aware of them before entering into any options trades. Liquidity risk. Options are a type of derivative, which means they derive their value from an underlying asset. The most common underlying assets are stocks, indices, commodities, and currencies. When you trade options, you are essentially betting on the future price of the underlying asset. There are two types of risks associated with trading options: directional risk and liquidity risk. Directional risk is the risk that the underlying asset will move in the opposite direction to what you have predicted. Liquidity risk is the risk that you will not be able to execute your trade at the desired price due to a lack of buyers or sellers in the market. Liquidity risk is often magnified in the options market due to the fact that there are often more sellers than buyers. This is because most option contracts are written by traders who think that the underlying asset will go down in value. As such, it can be difficult to find a buyer for your contract when you want to exit your position. Another factor that can impact liquidity is time decay. This is the rate at which an option's value decreases as it approaches its expiration date. Time decay accelerates as we get closer to expiry, so it's important to keep this in mind when trading options. If you're thinking of trading options, it's important to be aware of all the risks involved. Make sure you do your research and understand all the factors that can impact your trades before entering into any positions. Some considerations. When considering trading options, there are a few key things to keep in mind. First and foremost, options are a risky investment. They are often complex and difficult to understand, which can make them dangerous for inexperienced investors. Another thing to keep in mind is that options are highly volatile. This means that they can fluctuate rapidly in price, and this can be hard to predict. Options can also be impacted by changes in the underlying asset, so it's important to stay up to date on news and events that might affect the price of the option you're considering. Finally, remember that options expire. This means that at some point, the option will no longer be valid and you'll need to sell it or exercise it before then. Make sure you understand how long an option is good for before you trade it so you don't get stuck holding on to an inactive option. Volatility and why it's important. Volatility is a key concept in options trading that refers to the amount of price fluctuation in the underlying asset. Generally speaking, the higher the volatility, the greater the risk involved in trading options. So why is volatility important? There are two main reasons why volatility is important for traders to understand. Number one, volatility can have a big impact on the price of options. For example, let's say you're considering buying a call option on XYZ stock with a strike price of $50. The current price of XYZ stock is $49 and it has a standard deviation of $2. This means that there's a 68% chance that the stock will be within one standard deviation of its current price at expiration, between $47 and $51. However, if XYZ stock becomes more volatile and its standard deviation increases to $4, then there's only a 34% chance that it will be within one standard deviation of its current price at expiration, between $45 and $53. This means that the option will be more expensive because there's less likelihood that it will expire in the money. And number two, volatility can have a big impact on your profit-loss ratio. If you're looking to make a profit from options trading, then you need to understand how volatility affects your profit-loss ratio. For example, let's say you buy a call option on XYZ stock with a strike price of. There are risks associated with trading options, but there are also potential rewards. It's important to understand both before you start trading. With a solid understanding of the risks and rewards, you can make informed decisions about whether or not options trading is right for you. When it comes to options trading, there are a few key risks to be aware of. These include exposure risk, liquidity risk, and early exercise assignment risk. There are also a few things to keep in mind, such as the impact of volatility and the expiration date of options. Overall, trading options is a risky proposition. However, if you're willing to take on the risk, there can be substantial rewards. Just make sure that you're fully aware of the risks before you start trading. Thank you for watching. Please do share your thoughts with me in the comments below and subscribe and like the video.